Welcome to episode 9 of series 3 of the OR Talks podcast. Today we'll be discussing taxation and business structures. Here are your hosts, Neil Seeger
and Marc.
So thanks for joining us. Today we'll be discussing, as I said in the intro, taxation and business structures. Now, what does that mean and what are we going to talk about? Well,
we have no special guests this week, it's just the two of us.
Yeah, but that is a really special guest. We are the special guest. I think we should be the special guest every time. Especially, the most special, actually. Well, we keep coming back.
Yeah, so we're here every time.
Absolutely. It's consistent. So I don't know if consistent means we're the best or not, but I'm going to go with the best. So we're going to look into business structures primarily for myself today. So it's going to be looking at if you are self-employed or limited company, whether income tax, capital gains tax, that's a different thing, corporation tax, how on earth we structure this and what it means. So I'm going to start off going through the limited company side of things. So what is a limited company? A limited company is an entity registered at Companies House. Okay, so it's in the public domain, public eye. Anyone searches you online, well, not you personally, the company, they can find the registered address, find previous accounts, find out who owns the company, who the directors are. So it's in the public eye. It's owned by shareholders. And any money that you put in when you form a limited company, for example, if you were to set up, quite common at the moment, a property company, and you were to inject the initial money in there for the deposit, that money is a loan from yourselves or for the directors or shareholders across to the company. And that can be taken out at any moment in time, tax-free. I'm going to stay away from the tax. I'm staying away because that's going to be what Marc's going to go through a little bit. Why do some people limited companies? Well, the shares are, you own a limited company via a share. So it's a piece of paper that says that you own that company. And say me and Marc, we're in business together. Congratulations, Marc. Then actually, if I have pensions and I have other income, and I don't want to take out as much money out of the company as Marc, we can have shares that have got a different class of share. So we can have, say, I have A shares, Marc has B shares, which means that we can take out different amounts.
Yeah, I think something people get confused about is the difference between directors and shareholders sometimes, don't they?
Yes.
They don't have to be the same people.
Okay.
So tell me, what is the difference? What does it mean?
So effectively, I always use an analogy of effectively a car. Okay, it's a terrible analogy, and you'll laugh at this. But effectively, if you imagine you're laughing, having started.
I'm trying to work out how you go to this.
So the directors are the people that drive the car.
Yeah.
Okay, so they're the ones that will choose the direction the companies go and actually make sure that it stays on the right track and actually what it's doing. Whereas the shareholders are more the people that own the V5, people that sign on the V5. So the V5, for people that haven't got cars, is a document that says they own that car. So you've got the person, so some people like for example, me, I own my car and I drive my car. But actually what you could have is you could be driving my car. So I own the car, I own the company, and you basically operate it and drive it. So you're the director and I'm the shareholder.
Got you. That's actually a pretty good analogy. I wondered where you were going when you said I'm going to use a car.
It's always risky when I'm talking about cars and where I'm going to be off.
Yeah, I think that explained it quite well.
Oh, I'm impressed. I'm taking that as a compliment. So obviously we've already said that limited companies are operated by directors. The one thing that people really like about limited companies is they have limited liability. So what that company does only affects that company. If there was to be any issues, then it only affects that company. So if a company was to liquidate, then it's only that company liquidating, not that individual. So in simple terms, your personal assets aren't at stake for the business. Yeah. Only what the business does is what's at stake. What tax does a limited company pay?
Corporation.
There we go.
It's the main one. So
yeah,
it's over to me to talk about the tax.
It is to talk to you about tax. Yeah. So how does that work?
So limited companies, they'll pay corporation tax on the profits that they generate throughout the year.
Yeah.
What confuses a lot of people is that the profits shown in the accounts are not always the same as what the taxable profits are.
Okay.
And that's because when Neil's compiling his accounts, he'll include things in there which aren't allowable from a tax point of view. such as depreciation,
Yeah.
client entertaining and things like that, they have to be added back in when we're working out your taxable profit. So that's why there's sometimes a bit of confusion. Well, my profits in my account show X, my taxable profit's different. So it's just a slight different treatment for the two. And then corporation tax, you've got two different rates at the moment. It's starting at 19% and it goes up to 25%. And that depends on your profit levels. So gets really confusing and really complicated.
Yeah.
So in a really simple way, up to 19% is up to £50,000 profits.
Yeah.
25% kicks in when you're over £250,000.
Okay.
Which leaves you a gap there of how much?
£200,000.
Quick maths.
I tell you what, I should have a job as an accountant.
So when you fall in between 50,000 and 250,000,
yeah,
there's something called marginal relief. So the rate you're going to pay is going to be somewhere between 19 and 25%, depending on where your profits sit.
Right.
Really complicated calculation. Not going to go into it because I don't want to bore everyone.
We could be here for a long time.
Yeah, and because it moves depending on where your profit is, it's different for everyone in that position.
But the simple one is actually, you put it spot on. The simple one is less than 50 grand, 19%.
Over 250, 25%. In between, somewhere in between.
Yeah, I love that. Absolutely spot on. Absolutely spot on.
And generally, that tax is payable 9 months and 1 day after the year end of the accounts.
So using December.
Yeah.
Nice easy one. December is my year end.
Yeah. So 9 months and 1 day, that will give you
1st of October.
1st of October.
Okay, so that's can we do before that? Yeah. That's just the last date.
That's the date that it's due. The actual tax return itself, slightly confusing, isn't due until 12 months after the year end.
So to say December 23, let's just say.
Yeah.
It was due to be paid on the 1st of October 23, 24.
Yeah.
And then the tax return was due to be filed by the 31st of December 2024.
Yeah.
12 months after.
Yeah, so the tax return is submitted after the tax is due, basically.
Logical.
Yeah, very logical. As with everything to do with tax.
Yeah,
very logical.
Yeah, that's the thing. If you watch loads of these, listen to loads of these,
yeah.
You'll realise there's things that you'd have thought would be one way and they're not, they're another.
Yeah. And as I say, that's generally when the tax is payable. When you get very large companies, which we won't go into, then have to pay in advance quarterly. So, but we won't go into that today.
That's a whole different podcast.
Yeah, the very basics of the structure is 9 months and 1 day after you pay it. You submit the return 12 months after the year.
But as always, we guide, we give people the information. We don't just leave you to figure out the tax. Here's a tax bill, figure it out yourselves. Unfortunately, we don't do that. We allow people to, to be guided by us.
Yes.
So we spoke about limited companies.
Yeah.
And we spoke about shareholders.
Yeah.
So if I'm a shareholder, okay, and we know what a shareholder is, the person that owns the company and the person that can take dividends from the company or part of the profit. How does that work?
So as an individual, you're then going to be taking your income from that limited company. So you'll be taxed on that as income tax.
Yeah.
There's various ways you can do this. The normal route is you'll take a salary and dividends.
Okay.
The salary is deductible from the company's profits. Dividends come out after the corporation tax has been accounted for. So it's going to be post-tax. There's no tax relief for the dividends. You get tax relief for the salary in the company.
Yeah.
The salary generally is set around the personal allowance of 12,500. 12,570 if you want to be pernickety, but
I mean, some people have that salary, so yeah.
So you set it at that because that means if they've got no other income, their personal allowance is covering that salary, so they won't pay any income tax on that.
Yeah.
And then everything else will be taken at dividends. The reason for that, 12,500, you're getting your national insurance credit for the year. So that's a tick. So your state pension, qualifying year, and other sort of benefits is ticked off.
Amazing.
Getting 12.5 grand of corporation tax relief in the company, and then you're paying no income tax on that because it's covered by your personal allowance. So
if I have a salary, let's just say it's me and you in partnership again, and actually I only take a salary out of the business.
Yeah.
So then I will pay £0 tax on that. I've got no other income.
Yeah.
I'll pay £0 in tax personally, but the company will save maximum of 25%. Of that 12,570.
Yeah, exactly.
That's amazing.
Yeah, so that's why we structure it that way. And then dividends are taxed at lower rates than what salaries are. So dividends are really confusing. Used to be about £2,000 tax-free allowance for dividends on the first 2,000 in a tax year.
Yeah.
That got cut to 1,000. And for the current year, 6th of April 24 onwards, it's £500.
Oh.
So it's barely worth mentioning now.
Well, that's how I'm pay tax on more now. Yeah.
And then after that, in your basic rate, you're paying tax at 8.75%.
Yeah.
Once you go over the basic rate, so when you're sort of looking at over £50,000 total income, you're looking at 33.75.
Yeah.
And then if you go into additional rate, which is over £125,000 income, you're then looking at 38.75%. So as you can see, really easy rates to remember.
Yeah.
But compared to a salary, you'd be looking at 20%, 40%, 45%. So dividends still do work out that little bit cheaper.
And the other thing that kicks into it and actually does muddy the water a little bit, and I'm not going to go too much, is national insurance.
Yeah.
So if you do have a salary, and people have this debate all the time: do I take a salary? Do I take a higher salary? No dividends.
Yeah.
And the one thing that kicks in and does, actually makes people pay more is actually consideration of national insurance.
Yeah.
That's something that's always worth considering when
Yeah.
you're talking about how you take your income out of your company.
Yeah, but that's very much the very basics of it.
Yeah.
That's the general, there'll be different circumstances for everyone. These are the little things you can do, but we won't go into those today.
Case by case basis.
Yeah, it is
Isn't it?
very
It's
much
just about
so.
asking, isn't it?
Yeah. And if you've got other income to factor in, then that can change it all completely as well. So
Absolutely. Yeah. I mean, other incomes like rentals,
Yeah.
very common at the moment. And if that's being taxed in as well, then, actually, where does it sit? And we run those calculations,
Yeah,
don't we?
that's
That
it.
probably happens every day.
it
We
does.
probably have that question and that calculation that we do. So that's limited companies. Then how else could, if I, we want to own another business, but I still want it in the public eye, I still want it in a company's house, but I don't necessarily want to have the limited company side of things. There are things called LLPs, which are limited liability partnerships. Quite common, and they come with a lot of the same benefits that limited companies have from an accounts point of view, not a tax point of view. We'll come into that in a little while. So what is an LLP? Exactly the same as a limited company. It's registered at the company's house. It's people can find it in the public eye. You can search accounts. You can do all the same things you can do in the limited company. The only thing is really different is the ownership. The limited liability partnership is owned by basically designated members. They're members. They're not shareholders and directors. They're members. How do they take their income? Well, it can be taken by a couple of ways. One way is a salary. Another way is by a profit share. That's the two ways that income is taken. There's none of this dividends and shareholders and whatever. It is literally a proportion of the profit or a salary that comes out.
Yeah.
Sometimes you have salary members, some people are profit, some people are a mixture of the two. Some people have a salary and a profit share. It just depends on the individual partnership setup. They'll generally have a partnership agreement, which will dictate, Mark's having a salary and Neil's having all the profit. Sounds amazing to me.
I was going to say, I don't know if that works. Unless we don't
Depends on
make
the
a lot of
profit.
profit, yeah. I was going to say,
Depends on the
running-
profit. You can have £100,000,
Yeah.
salary, and I get a
Okay.
£50,000 profit share. So I'm just a nice guy.
Yeah.
So, and it's a mixture between all of them, but operationally, from a business point of view, they operate exactly the same. It's just going to be from a tax point of view how they sit and how money is taken. So I'm going to stay away from the tax. I'm not going to talk about the tax. How are they taxed, Mark?
So the tax is income tax, basically. So the individual members will be taxed on their profit shares from that, basically.
Yeah.
So it works very similar to partnerships and sole trades, which I think you're going to talk about.
I'm going to come on to them in a little while.
So I might let you talk about how they work, because the tax is very much the same for
Okay.
all three of these. So do them all in one go.
Back to me chatting again then.
Back
You
to you
lucky
on the
people.
partnerships. What's the difference between a partnership and an LLP then?
So an LLP is registered at company's house, whereas not a normal partnership, but a partnership as it's actually two people. So what is a partnership? It's probably a better way of putting it, actually. So it's an arrangement between two or more people to oversee business operations, and they share the profits and the liabilities.
Yeah.
So effectively, it's similar sort of principles on LLP. You're still in partnership together. You just don't have the limited liability that comes with it. Again, it's profit share. It's but not registered at company's house. And the key is the limited liability. This is unlimited liability. So if something was to go wrong with that, all your personal assets are at stake.
Okay, so yeah, it's less secure from that point of view.
Correct. It depends on, it depends on what the nature. I mean, how do people decide which way they're going to do it? Well, some people don't like having things in the public eye.
Yeah.
If the tax affects the exact same, why would you want your accounts in the public eye?
Yeah.
That's one consideration for some people. Other considerations is what you do. So if you were to be, I've used the example on historic ones. If you were to be a heating engineer, for example, dealing with gas or dealing with any industry that has a risk to it, you'd probably more want to be gearing towards the limited liability partnership than the standard partnership, because you've got that protection that comes with it.
Yeah.
You know, in simple terms, there's an awful lot more considerations to have within there, but from a legal point of view, there's some more considerations. But it's just a case of actually which one suits. You know, I know I have clients of mine that don't want to be in the public eye. They want to keep their figures between them and HMRC, or well, their accountant and HMRC. They don't want it in the public eye. So if you don't want to be a partnership, well, if you can't be a partnership, you're going to do it yourself.
It's going to say, to be a partnership, you have to have more than one person. It's going to be.
Yeah, it's going to be a bit awkward, that really. It's just me. I can't partnership myself. Yeah,
you can't bring your dog in, or
no, unfortunately, they don't qualify as partners. So I did say it was 2 or more. So if it's just you, and you don't want to be a limited company, then what are you? Well, then you become a sole trader. Now, a lot of people potentially have heard of sole traders, but if they haven't, what is a sole trader? Similar to a partnership, it's not registered in registered company's house, so no one can find anything, any information about where you live or where it's registered or who runs it. Nobody can find that out just with a simple tap into company's house. It's a self-employed people are by themselves running their own business. I think that's where the sole trader comes into it. They're taxed, I know Mark's going through a little bit, but their tax basically is, their tax is based on their profit share, not what they draw, it's just their profit share. And again, the same applies with the liability, it's unlimited liability. So again, you're a heat engineer, you get something that doesn't go quite right, and somebody tries to, you know, sue you, then your personal house is at stake, whereas a limited company, the LLP, would provide you a bit more protection.
Got you.
So tax.
So tax.
I've avoided it. I've been really good. I haven't mentioned.
I'm impressed. I'm impressed.
How, if I'm an LLP, if I'm a partnership or a sole trader, how do I get taxed?
So LLP and a partnership, they'll have their accounts produced, and then there'll be a profit share for each member or each partner in line with the partnership agreement, like Neil said. So that is then liable to income tax. As a sole trader, you'll have your accounting profit, which again, as with the LLP profits and partnership, like the limited, will sometimes be slightly different for the tax adjustments we talked about.
Yeah.
But then those profits, whatever your share of the profits are, as a sole trader, 100%, partnership, whatever your share is liable to income tax.
Yeah.
And that's at the same rates as what you pay as an employee. So you have your personal allowance, 12,570, and then you've got your 20%, 40% and 45%, depending on what bracket of income you're falling into.
And are those bands the same? You don't spoke about shares, receiving dividends. Are those bands the same?
Yep, they are. Yeah, so you've got your first up to 50,270, including your personal allowance.
Yeah,
20%, and then 40% up to 125, and then 45% above that.
Wow.
So that's how the income tax works. You've also got to factor in, as we mentioned earlier, national insurance.
Okay.
So national insurance is 6% on your profits over 12,570, and then over 50,270, it's 2% for anything over that.
Wow.
So you've got your income tax that you pay on there and your national insurance.
It's worth noting on that, actually, that national insurance has reduced over the last couple of years.
It has indeed, yeah, it's come down. And there used to be class 2 national insurance as well. We won't go into that because the rules on that are all changing. And we've got a budget coming up at the end of this month, which could...
We could throw all this out.
Yeah, that was what we were going to mention at the end about.
Oh, sorry, spoiler alert.
But you've got it there already. But yeah, so that's basically how an individual as a sole trader is taxed on that. And the other thing to bear in mind is if you've got other income, that factors in and it can push you into different bands as well. So your income's a cumulative thing, so it's all added in together to work out where you're falling in the bands. So
it's all my income. So if I've got income from bank interest, I've got income from my sole trader, and I seem to be really busy, and I've got income from dividends, and you know that all that is pulled into one.
Yeah, so they can all push you into different bands and things like that. So as a rule, your self-employment would be tax first, and then your interest, and then your dividends last.
Right.
So, but yeah, it does all affect where you fall.
Wow, it's worth considering then, isn't it? So that is why, you know, when we talk to clients quite a lot, it's all actually, some people have got limited companies for their trade because their employment income is over 50,000.
Yeah, and they don't want to take any more out of the company for them. Yeah.
Correct, yeah. So it's all about whether, and if you need all the money, there's all the considerations. If you need the money and you want to take the money, it might not be tax efficient to be a limited company.
Yeah.
But if you want to save the money up in a limited company and have your salary, then it might be.
Yeah.
And this is the conversation that we have all the time. It's a case of looking at every angle of bit of income and information and putting together a strategy for each person, isn't it?
It is. It is. So if you're a member of an LLP, partnership or sole trader, this tax has to be reported on a self-assessment tax return. And the UK tax year, for those of you who don't know, really awkwardly runs from the 6th of April to the 5th of April every year.
Yeah.
Nice and straightforward.
Yeah.
Most of the countries around the world do it January to December now.
Yeah.
We're still 6th of April to 5th of April. So that return has to be submitted by the 31st of January following the end of that tax year. So tax year ending 5th of April 24 now.
Will be the 31st of January 25.
It would. Well done.
Perfect. I do learn stuff. I listen to you. I do listen.
And the tax is also payable by that day.
Okay.
Generally.
Yeah, yeah.
So it becomes a bit more complicated once you've been trading a little while. If your income tax liability each year is over £1,000,
yeah,
HMRC will want you to pay payments on account.
Okay.
These get really confuse everyone when they first start paying these. They're basically advance payments towards the next year.
Right.
So these are due. So if your tax liability for the year ending 5th of April 2024 was £1,000, HMRC would say you've got to pay that £1,000 by the 31st of January.
Yeah.
But they also want payments on account towards the year ending 5th of April 2025.
Okay. Yeah.
Which would be that £1,000 divided by 2, paid once in 31st of January 25 and 31st of July 2025. So you'd actually end up paying £1,000 liability on the 31st of Jan.
Yeah.
And £500 payment on account. And then again in July, another £500.
That's only in year one.
Yeah.
And then year two. If let's just say for the sake of argument, it's really simple, and my tax liability the year after was £1,000.
Yeah.
Let's just say.
Perfect.
And my payments on account. So I paid my January 25 one.
Yeah.
And my July 25 one.
Yeah.
Which were basically, so I've already paid £1,000.
Yeah.
If we came to middle of August of tax, which was for the year 5th of April 2025.
Yeah.
So when I came to January 26th and it was due for payment, I actually only paid £500, wouldn't I?
Because for the next year, you've already got that £1,000 in the bank as a pool, basically.
So I don't lose it.
No, it's not lost. It's just getting it in a bit quicker for HMRC.
It's just an advanced payment, isn't it?
Yeah, and it helps a lot of people out rather than having a big liability at the end of January. They've already got some on account towards it. The first year is the worst.
It's painful by the sound of it, yeah.
Yeah, because you haven't got that pool already there, but going forward, you've got it there, and it's.
So it's almost worth when you say your tax bill as you go along and whatever, actually having that conversation with the tax professional, saying, well, actually, this is where I'm at.
Yeah.
Have I saved up enough? Have I saved up, too much? And actually, that conversation, isn't it? It's worth.
It is, yeah, definitely. So you don't want to get to near the end of January and not have the money there to pay it.
I've had Christmas.
Yeah.
I've had Christmas and I've had New Year, so I haven't got any money for my tax bill.
Exactly. It's a terrible time of year, isn't it? So.
And they get it in Jan as well, yeah.
So yeah, forward planning with that. Have to get it.
I knew it was going to come up somewhere. I thought, I'm happy now. I missed that comment. It is all about that forward planning, isn't it? And that's whether you're a limited company, whether you're a sole trader, partnership, LLP. Yeah. It's all worth considering, where all the taxes sit. So that's the business structures and the taxes that come with them, which we all get quite a lot of questions about all those all the time, haven't we?
People starting up, it's all brand new to them, isn't it? So even people that have been involved in businesses, sometimes they haven't dealt with the tax side or the accounting side. So everybody can learn from it. And
people ask me all the time, why do I need an accountant? If I set up myself self-employed, then why do I need you? Well, actually, it's that exact thing. I think that in year one, in fact, I had a client come to me yesterday and they was like, in year one, my turnover, I know this for a fact, is going to be £70,000.
Yeah.
I know that. So what's my tax bill going to be? Well, cost-wise, what costs you paying? And you can mock up really to a rough tax liability of where you expect that to be. And it's going to change, obviously, but at least you've got a guide.
Yeah.
And that's really important from the get-go to have that.
And the UK tax legislation is horrendously complicated as well.
Yes.
Have a stab in the dark. How many pages do you reckon it is roughly?
UK tax legislation. I don't know. It can't be that bad. 100?
Higher.
Higher? Oh, right, higher or lower?
Yeah.
Go on, how many pages is it?
It's roughly around 20,000 pages.
20,000 pages?
20,000 pages long. This is why we don't go through it all in massive detail for you. We simplify it.
No wonder people get confused.
Yeah. Compare that to Hong Kong's, which is roughly 270 pages.
Ah, see, I'm close to them.
So yeah, it's tax legislation in the UK is horrendously complicated. 20,000 pages. That's why you should always really seek professional advice.
Start reading now. I can have that done by the end of next year.
You'll fall asleep a lot at that time.
I can imagine, but it is also the fact that different taxes pull in as well. So actually, it's to save yourselves reading all those pages. It's just speak to a professional, I suppose, isn't it?
That's it.
Wow, well, that's important. I don't know what to say. I don't know what to say about that. I am certainly not going to read them.
Doesn't happen very often, does it?
It doesn't. So, what other taxes are there to be aware of that affect businesses, that affect people that aren't in business? Really,
everyone should be aware of.
What the first one we've got is, and we'll go through in more detail in a minute. Don't worry. It's stamp duty, land tax. I'm not sure if I say land tax, or people get confused. Capital gains tax. There's payroll taxes if you're employing staff, or even if you're not employing staff, if you're a director, there's payroll taxes that kick in. Research and development, which is I'm not going to go into detail on that one today. There's VAT. I'm not going to go too much detail on that one. I'm just going to go around it. And there's also inheritance tax, which is a lovely in-depth topic as well. Again, today is not going to go into them in loads of detail. It's just going to be a case of actually these are the ones to be aware of, and this is what they mean. Okay. So, stamp duty, it's your baby.
Stamp duty, land tax.
Land tax, sorry.
So, stamp duty, land tax. When you buy a property, is a tax that you're going to be affected by. There's various reliefs. So, if you're a first-time buyer, you might not have to pay any. But generally, when you buy a property, stamp duty, land tax is going to apply for you. So, companies and individuals pay different rates. So if you're buying property in a company, a residential property, you pay an extra 3% compared to an individual.
Okay.
If you're buying non-residential property, the rates are cheaper than what they are if you're buying residential property. So there's a surcharge on residential property, basically. More expensive to buy. The other thing that catches a lot of people out is if you're an individual and you already own that property and you want to buy another one to rent out, or then pay an additional 3% on top as well.
So it's not just limited companies that pay extra. If I've got a second property in my own name, I pay more.
You pay an extra 3% as well on top of whatever the rates are at that point. So it's just one of those taxes getting more and more complicated. When it was first brought in, it was quite simple. But as time's gone on, more legislation's been added in, it's become more and more complicated.
But there's an awful lot of reliefs with stamp duty, land tax.
There are,
well.
And
we have this all the time, don't we? With talking to other professionals, we see that actually stamp duty confuses professionals, let alone people that are just buying houses.
Absolutely. So we'll leave it at that one, stamp duty.
Absolutely fine. So the other tax, which is an interesting one. It's a good grammar tax person. It's great. Capital gains tax.
Capital gains tax. Something that has come up so much at the moment because people are worried about what's going to happen in the budget. So because of what's going to happen in the budget, I'm not going to go over any rates or anything.
What? That's false.
It could all be out of date in like 14 days.
What does it apply to?
So it's generally on the sale of assets. So things like shares in companies, properties, but generally not your own residence, unless there's been a time where you haven't lived in it as your own residence. But if you buy a house, live in it, sell it, generally no capital gains tax applies because there's a relief that covers it. So basically it's on the profit. So say you bought a buy-to-let property, £200,000. You then go on and sell it for £400,000. You've got £200,000 profit there.
Yes.
That is what will be liable to capital gains tax. So people get confused sometimes and they think that it's on the actual sale proceeds, but it's not. It's
just on the profit.
Yeah,
that's all right then. I'm not going to pay on the whole lot then, am I? If I pay mortgage, then
Yeah,
I'm still happy.
Yeah, exactly. Yeah, so it's not always quite as bad as what people think. Currently, the rates for residential property are higher, so it's 18 and 24%, depending on what your income level is.
Yeah.
Non-residential properties, so things like shareholdings or commercial properties, at the moment are 10% and 20%. If you're selling shares in like your own trading company, there's a relief called business asset disposal relief.
Okay.
Which means on the first £1 million of gains relating to that in your lifetime, that is, so not a tax year, unfortunately, your lifetime, that's at 10% rather than 10 or 20%. You get the 10% on the whole £1 million, but that is a lifetime allowance.
Okay. So if I sold one today for £1 million and then 10 years time sold one for £1 million, I'd pay normal.
Yeah, exactly. Yeah. You only get that 10% business asset disposal relief.
So what happens? What happens if I'm a limited company and I sell my buy-to-let?
So in the limited company, it's still taxed as corporation tax, so you'll still pay capital gains tax in effect on basically the profit of that sale, but it falls into your corporation tax. So it's not a separate capital gains tax like it is for individuals.
I was watching a video on that actually the other day, and the person who was doing the talk, they said that limited companies do not pay capital gains tax. Which actually, they weren't wrong because it's not capital gains tax.
It's misleading.
But it's misleading because actually that is corporation tax.
It's just all badged as corporation tax.
Yeah.
Still a chargeable gain.
And that's what we do. That's what we do these, isn't it? Because actually, it's making those things that in reality you've watched that video, you've got brilliant, I can somewhere else and not pay tax.
Yeah.
And then you get some with a tax bill. So surprise. So I mentioned earlier that we would go into inheritance tax briefly.
Down.
Well, that's why I've done it now, because I'm going to go into other things. I couldn't leave that as on my list. It was the last tax, and I thought I can't leave until the end.
You don't want to finish on inheritance tax.
No, you don't. No. So what is inheritance tax?
It's one of the most hated taxes, I think, that's out there. I don't think any tax is popular.
That's okay. No.
So inheritance tax, it's the tax that you pay on your estate that's left after you pass away, basically.
Okay.
So it's paid by the estate that you leave. Each estate starts off with a nil rate band of 325,000.
Okay.
Which means on that first 325,000, no inheritance tax is due.
Brilliant.
That can be increased. So if you pass away and leave all of your estate to your wife or husband, your surviving spouse, your nil rate band isn't used at that point, because gifts that are left to surviving spouse are inheritance tax free.
Right.
So because you haven't used your £325,000 nil rate band and you were married at the time you passed away, that can be transferred to your surviving spouse.
So they have 650,000.
Yep. So they have their 325,000 themselves.
Yeah.
Plus the 325,000 that their deceased partner didn't use.
Okay.
So they've now got £650,000.
Well, that's good.
It is. I mean,
you're some bad news in a minute. Well, I'm going to lock my partner. Obviously, that's very sad.
No, it is. Yeah,
the tax point of view, that's good.
The partner.
I'm talking purely tax.
Yeah, obviously, if that new rate band is used because some of that the estate on the first death is left to children or someone else, there isn't going to be the full 325. But it's a very simple situation. The whole estate is left to the surviving spouse. Then you've got 650 on the second death.
The key is married. That's the key in that. So if you're
married or civil partnership, but
so if you're two people cohabiting for forever and you're not married or civil partnership, this doesn't apply. They're two separate. They're two separate people, really.
Yeah, which people often hear about that. Oh, you can get to £1 million tax free. Yes, you can, but it has to be married or civil partnership. So when you hear that £1 million, we've just got you up to 650.
Yes.
So
where's the rest? How does the rest happen? And that's what involved my next question, because I was about to use my fingers to figure out that actually we've got a slight difference here.
I mean, if you've got 1 million fingers and thumbs now, we've got a problem there.
Just see how many toes I got. Everybody's in my hands.
Yeah, that's it. He's very proven he hasn't. So you can get up to £1 million. How? So there's also something called the residence nil rate band.
Okay.
Which only applies to the gift of your home that you're living in. If you've gone into care, then it can still qualify.
Oh,
But yeah, your home that you were living in at the point you died or went into care, basically, you get £175,000 nil rate on that if it is left to a direct descendant, being children or grandchildren.
ah,
Again, if on your death it's left to your surviving spouse, that is unused and that can be transferred to your surviving spouse. So then they've got 350,000,
yeah.
which add to 650.
Ah, it's a million.
That's where the magic million comes from.
Right. Okay.
Now, a little bit more bad news on that.
Ah,
If the total value of your estate exceeds £2 million, the £175,000 residence nil rate band starts to get tapered away.
oh, right. Oh,
So for every £2, sorry, that your estate goes over 2 million, you lose £1 of that 175.
oh, what?
So yeah, that's a bit of bad news. The nil rate band of 325, that remains regardless, but that residence nil rate band, when you're over 2 million, starts tapering away.
So while we're on bad news, I might as well ask a question. I know it's gonna be bad news. So if I'm over the thresholds,
Yeah,
so over the, let's say we keep it simple. I haven't got, I haven't got my own house or whatever, and actually I've only got me 325, it's just me by myself.
yeah.
My estate is worth more than 325,000. How much tax do I pay?
So the amount over 325,000 would be liable to 40% tax.
40%? Oh, what?
40%, yeah. But the thing with inheritance tax, there's lots and lots of different things you can do to plan for it.
Okay.
So don't just leave it.
So I haven't got necessarily, I can get around it.
Not get around it necessarily,
Oh.
but you can give things away during your lifetime if
Okay.
you don't need them. There's lots and lots of planning that you can do. And it's very important that you get a will if you haven't already got one.
Yeah.
And that you look at what the inheritance tax would be as a result of that will. Because there might be little things you can do to change the will to make it more tax efficient.
Ah, I'm feeling a word coming here from you. Or a couple of words.
Forward planning.
It was forward planning. I was really coming from you, honestly.
Yeah. So inheritance tax is one of those things. No one likes to talk about it.
No.
It's pressing. It's talking about death. But it's one of those things. Make sure it's in order.
Well, I'm going to make things more fun now. I think I'm going to be talking about payroll taxes now. I know. So what are payroll taxes? What do they mean? And when do you pay them? Well, effectively, if a company, partnership, sole trader, whatever, has got employees, it doesn't matter your business structure. If you've got employees, then there's things to consider. Things to consider are employers' national insurance. Okay, I'm not going to go into all the numbers. It's just something to be aware of because, again, things are going to change in the very near future. I don't want to confuse people. So, employers' national insurance. If you're employing people, it's always worth considering that you're going to have to pay employers' national insurance on top of that salary. Okay. Important to remember that you've got pension contributions. So, there's a thing that came in a few years ago now, called auto enrolment. Okay. I know, yeah. It makes everyone, oh no.
It sounds so simple. Auto enrolment, it's done for you.
No, it's not. I wish it was done for you. It's not. It's something that you have to, basically, you have to pay. The employee has to, well, they have the option to opt into an auto enrolment scheme. Okay. So they have to contribute if they don't want to. They have to opt out. They have to opt in before they can opt out. So if you've got a new employee, the chances are you're going to have to enrol them. And they're going to have to pay some pension contribution, and you're going to have to pay some of the employer on top. Percentages are going to vary, but again, it's worth, if you're taking somebody on, please make sure that you, well, first and foremost, make sure you've got employment contract. I can't even talk. Contracts of employment. You got to make sure you have. On top of that, you've got to build in these extra costs that kick in. People think you take someone on and pay them a salary of 30 grand, it only costs them 30 grand. It doesn't. In some cases, it costs more, but it just depends on the number of employees you got. It's all a case by case basis. Another sneaky thing that pops up, and I've seen it with quite a lot with the people buying electric cars or giving pay rises to people via the electric cars or electric cars is primarily what I'm seeing quite a lot at the moment, or healthcare insurance, private healthcare. They're quite, people, here's a package, 30 grand. And by the way, we're going to put it into Bupa and other providers out there. And also, and actually, you go and buy an electric vehicle, then actually there is tax to be paid on those. And also there's a thing called Class 1A, which is the national insurance, which you end up paying on that company vehicle.
So it's just more cost for the employer.
It's more cost that you have to build in. People think it's 30 grand plus 5 grand a month. Five grand a month. Right? It's a very grand car. £500 a month for the car. It's not. It's going to cost more on top. So it's please, if you're going to employ people, go on, contact people, contact us.
Yeah.
And we'll put you in touch with our payroll team about how much it's going to cost of employing, a total cost of employing that employee.
Yeah, definitely, because the cost to them as well will be deductible against corporation tax profit.
Absolutely.
So that's things that we'll look at to give you the net cost rather than what the actual.
It's worth considering all for the business. You know, if you're the owner and the owner managed business, you're the shareholder, you're the director, and and you're employing somebody. Actually, you're looking at the benefits between everybody, then, aren't you?
Yeah.
My last one is VAT. A lovely, nice, simple topic. I'm not going to go into what's exempt and what's zero rated and all that sort of things, because we haven't got time for that, and we'll be here for a long time. It's a separate podcast by itself, I think. But the key thing that people get confused about is when to register for VAT and how to register for VAT, and actually what on earth does VAT registration mean. In a nutshell, if your turnover, so the amount you charge your customers that's come in a 12-month period, is £90,000 or more, you have to VAT register. Okay, assuming that they're all qualifying services of VAT, so they're not exempt. If they're zero rated or if they're standard rated, so zero rated is obviously 0%, but it's still VAT charge, but at a zero rate, or it's a standard rate, which is 20%, then you'd have to VAT register. What does that mean? It means you have to do a VAT return every month, every quarter, to pay the VAT that you've collected from your customers over to the revenue. But it's not all doom and gloom, because you can actually claim back VAT on anything that you buy that's got a VAT on it. So it's not just collecting and pay over. Actually, you offset the things that you've bought. So if you rent a premises that has got VAT on it, you get to claim the VAT back on that. Any materials you buy, you get to claim the VAT back on those. So it's not all you just collect and pay. Actually, it might be something that benefits the business.
Okay, so you can net it off effectively.
Yeah, you net it off. Yeah, a lot of people are scared of VAT, don't like VAT, want to completely avoid VAT because they don't quite necessarily understand it.
Yeah.
But actually, all it means is you've got to, if you charge your customer 10 quid for a glass mat, then it's actually plus the VAT, it's £12. So that £2 is your VAT money. You'll still get the same 10 quid you used to get, but actually you get to claim the VAT back on any materials you buy. So if I had to pay you and you charge me £5 plus VAT, actually conveniently that's £6. £1 of it I end up claiming back.
Yeah.
So I only pay the revenue actually, or HMRC, £1 on that transaction.
Got you.
So it's nothing to be scared of, but it's worth looking at. If there are certain things, actually we've written a presentation that we've got to present in a couple of days, and that's looking at doctors. So you can imagine in their world, there's the things that are exempt, zero rated and VATable. The list is endless.
Yeah.
But if you are in doubt, just ask.
Yeah.
That VAT's a world where actually, if you think it's exempt, the chances are it is. But it's always best to be safe, because if you don't charge VAT and you go over that 90,000, then you're going to end up being liable for the bill.
Yeah, you don't want to get caught out by it.
Yeah. You don't. It comes back to that nice little word, doesn't it?
Bit of forward planning.
Bit of forward planning. So really, what are the benefits to being VAT registered? Well, you get to claim the VAT back on any materials, as I said. You can claim back if you've got any equipment. So you bought a big digger and you're going to have it registered. As long as you bought it in the last sort of 3 years, then you claim the VAT back on it. But it's something that you've got to look at really, because it might not cost you as much money as you think. Drawbacks that a lot of people see is it's potentially people see it as more admin time, but actually you might end up being financially better off. Potentially, it just depends. And it's that actually I'm then going to be HMRC going to come knocking my door every year to have a look at my books. It doesn't work like that. Obviously, it's a case by case basis. Some people, they might register today and they get a knock on the door tomorrow. But actually, on the whole, it's not. But people imagine that world's going to be like that. It's
Yeah.
not. It's really, really not. But actually, I see it as a compliment being VAT registered because your business is performing. I
Yeah,
think some
different
people
way.
try and fight and try and, I spoke to somebody the other day and they've just stopped working for the rest of the year because they don't want to go over the VAT threshold. I'm thinking all that extra money they could be getting.
Yeah,
And they're not, they just stop working. I mean, okay, again, that
It's their-
helps them, that's fine. But actually don't stunt the growth of your business because you're worried about VAT.
Yeah.
Come talk to us and we can
Yeah.
talk to you about it.
it's a lot easier to manage now as well with software, isn't it, as well?
Yeah.
There's software's out there that
Oh.
can help you so much. So the admin isn't as daunting as well.
No, the software is brilliant for that.
Yeah,
I think that's all the stuff I've got on
covered quite a lot there. To be
business
fair.
structures and tax. Yeah, there is an awful lot in there. And again, we've not gone into massive detail into everything. Today is a sort of an overview of business structures and what taxation kicks in and the key dates to be aware of. We'll go through them, the key topics later on in other
Future
in
podcasts.
other podcasts. Yeah, future podcasts. Yeah, but I think that's everything. Thank you, special guest.
Thank you. And so thanks for joining us today. Hopefully you found that interesting. And if you need any more advice or any more support, please feel free to get in touch. The next podcast is going to be looking at the upcoming budget that we touched on briefly in this one.
Ooh.
So 30th of October, the budget's coming out.
Yeah.
We'll see what changes are brought in.
Yeah.
And we'll go through those and give you our thoughts on them and what it means for people like you listening.
And what that means in real terms.
Yeah, exactly. So until next time, thanks for joining us.
Thank you.